Hey everyone, and welcome back to Money Talks US. Today we're going to talk about a set of tools that are one of the most popular and accessible for everyday Americans, yes, that means you, to start investing and building wealth over time, the ever-popular mutual funds. Forget the Wall Street jargon and the intimidating charts for a moment. By the end of this video, you'll not only understand exactly what mutual funds are and how they work, but you'll also see why they could be your superpower for achieving your financial goals. So grab your favorite beverage, settle in, and let's unlock the power of mutual funds simply and clearly. All right, let's get straight to the point. What on earth is a mutual fund? Imagine you and a whole bunch of other people, friends, neighbors, even strangers from across the country, all want to invest in the financial markets. But maybe you don't have millions of dollars lying around, join the club, or you don't have the time to become a stock picking guru overnight. This is where mutual funds come in. A mutual fund is essentially a professionally managed investment company that pools money from many investors, thousands, sometimes millions of them. Think of it like a giant investment potluck, or even better, a massive investment salad bar. You bring your $50, Sarah brings her $200, Mike brings his $1,000. All that money goes into one big bowl. Now, what does the mutual fund do with all this pooled cash? It takes that collective pot of money and invests it in a diversified portfolio of securities. These securities are typically things like stocks, which are tiny pieces of ownership in companies like Apple, Amazon, or even smaller up-and-coming businesses. Bonds, which are essentially loans you make to governments or corporations, and they pay you interest. Other assets. Sometimes funds might invest in things like real estate or commodities, though stocks and bonds are the most common. So, when you invest in a mutual fund, you're not buying one specific stock or one specific bond. Instead, you're buying a share of the mutual fund itself, which in turn owns a whole basket of different investments. You become a part owner of this big, diversified investment salad. The core concept is simple. Many people, pooled money, diverse investments equals mutual fund. We're breaking it down. So, you've got this giant pool of money. Who decides what goes into the investment salad? Who picks the specific stocks and bonds? You don't want just anyone throwing random ingredients in there, right? Enter the fund manager, or a team of managers and analysts. These are the financial professionals, the investment pilots, whose full-time job it is to make the investment decisions for the mutual fund. Their mission, should they choose to accept it, and they do, is to manage the fund's portfolio according to its stated investment objective. For instance, a growth fund manager might look for companies they believe will grow faster than average. An income fund manager might focus on investments that pay regular dividends or interest. A small cap fund manager will specialize in investing in smaller companies. These managers and their teams spend their days researching companies, analyzing economic trends, assessing risk, and deciding when to buy, sell, or hold particular investments. They're essentially doing the nitty-gritty investment work for you. This professional management is a massive benefit, especially if you're new to investing, you don't have the extensive financial knowledge required for in-depth analysis, or you simply don't have the time or the desire to research hundreds of individual companies. You're leveraging their expertise. It's like hiring a seasoned chef to cook your gourmet meal instead of trying to figure out a complex recipe all by yourself after a long day at work. Now, it's important to note, some mutual funds, called index funds, which we'll touch on more later, don't rely on a manager actively picking investments. Instead, they aim to passively track a market index, like the S&P 500. This often means lower fees, but the principle of having a defined strategy for the pooled money remains. This next benefit is a huge one, folks. It's a cornerstone of smart investing and something mutual funds do exceptionally well. Diversification. You've all heard the age-old wisdom: don't put all your eggs in one basket. In the investing world, this is gospel. If you sink all your money into the stock of just one company, let's say Bob's Amazing Widgets Inc., and Bob's Widgets suddenly become unamazing and the company goes bust, well, your investment could go down the drain. That's a massive risk. Mutual funds inherently provide diversification. Because they're working with that large pool of money from many investors, they can afford to buy a wide variety of different investments. Instead of owning stock in just Bob's Widgets, a single share of a mutual fund could give you a tiny piece of hundreds or even thousands of different companies. Look at this. A typical stock mutual fund might hold positions in tech giants, healthcare innovators, stable utility companies, international businesses, and more. It might also hold different types of bonds if it's a bond fund or a balanced fund. Why is this so powerful? If one company in the fund has a bad quarter, or one particular sector of the economy hits a rough patch, the other investments in the fund can help cushion the blow. The idea is that not all investments will perform poorly at the same time. Some might go up while others go down, or some might just hold steady. This helps to smooth out the ride and, most importantly, reduce your overall risk. Trying to achieve this level of diversification on your own as an individual investor would be incredibly time-consuming and expensive. Imagine researching and buying shares in 200 different companies. The brokerage fees alone would be substantial. Mutual funds make this instant diversification affordable and accessible. It's like having a well-balanced diet for your money, instead of just eating pizza every single day, as tempting as that might be. Diversification is your portfolio's built-in safety net. Okay, so we've got pooled money, professional management, or a set strategy, and diversification. But how do you actually own a piece of this mutual fund? And how is its value determined? When you invest in a mutual fund, you're not buying the individual stocks or bonds directly. Instead, you buy shares of the mutual fund itself. Think of our giant investment salad or that pizza. The mutual fund is the entire pizza with all its varied toppings, the stocks, bonds, etc. When you invest, you're buying a slice or several slices of that pizza. Each slice is a share of the fund. The more money you invest, the more slices or shares you own. The price of one share of a mutual fund is called its net asset value, or NAV. This sounds technical, but it's pretty straightforward. The NAV is calculated once at the end of each business day. It's the total market value of all the securities held by the fund, minus any liabilities like operating expenses, divided by the total number of shares the fund has issued to all its investors. So, let's say a fund's investments are worth $100 million. It has $1 million in expenses or liabilities, and there are 9 million shares out there owned by investors. The NAV would be 100 million minus 1 million divided by 9 million shares equals $99 million divided by 9 million shares equals $11 per share. When you buy shares of a mutual fund, you typically pay the NAV calculated at the end of that trading day, plus any applicable sales fees, which we'll discuss. When you decide to sell your shares, you'll receive the NAV at the end of the day you sell. If the value of the underlying investments in the fund goes up, the NAV per share goes up and your investment is worth more. Ka-ching! If they go down, the NAV goes down. So if you bought shares at $11 and the NAV rises to $13, your shares are now worth $13 each. This end-of-day pricing is a key difference from individual stocks, which can be bought and sold throughout the trading day with prices fluctuating constantly. Just like there isn't just one type of car or one flavor of ice cream, mutual fund is a broad category. There's a whole universe of different types, each tailored to different investment goals, risk appetites, and time horizons. Let's look at the main flavors. 1. Stock funds or equity funds. These are the rock stars, primarily investing in stocks or shares of companies. They aim for capital growth over the long term. They can be broken down further by A, company size, large cap, big established companies, mid cap, medium sized, small cap, smaller, potentially faster growing companies. B, investment style, growth funds, which focus on companies expected to grow rapidly, versus value funds, which look for undervalued companies. C, geography, U.S. stock funds, international stock funds, emerging market funds. Stock funds generally carry more risk, but also offer higher potential returns. 2. Bond funds, or fixed income funds. These invest in bonds, which are like IOUs from governments or corporations. They are generally considered less risky than stock funds and are often used for income generation from interest payments and capital preservation. Think of them as the steady, reliable choice. 3. Balanced funds, or hybrid funds. These offer a mix, investing in both stocks and bonds, and sometimes other assets like cash. The goal is to provide a balance of growth from stocks and income and stability from bonds. The risk level is typically moderate, somewhere between pure stock and pure bond funds. 4. Money market funds. These invest in very short-term, high-quality, low-risk debt securities. They are considered very safe and are often used as a temporary place to park cash while aiming to preserve your principal and earn a little bit of interest. Similar to a savings account, but they are still investments and not FDIC insured. 5. Index funds. This is a hugely popular category. An index fund is a type of mutual fund that aims to replicate the performance of a specific market index, like the S&P 500, which tracks 500 of the largest U.S. companies, or the NASDAQ 100. Instead of an active manager picking stocks, the fund passively holds the investments in the index. Because there's less active management, index funds often have significantly lower fees, expense ratios, which is a big plus for long-term returns. Many legendary investors, including Warren Buffett, often recommend low-cost S&P 500 index funds for the average investor. 6. Target date funds. These are often found in 401k plans. You pick a fund with a year closest to your expected retirement date, like Target Date 2050 fund. The fund automatically adjusts its mix of stocks and bonds over time, becoming more conservative, more bonds, less stocks, as you get closer to that target retirement year. It's a set it and forget it option for retirement savings. And there are even more, like sector funds, focusing on specific industries like tech or healthcare. The point is, there's a mutual fund out there for almost every investment strategy and goal. So, let's quickly hit the highlights. Why are mutual funds such a big deal for so many investors? 1. Instant diversification. We've covered this, but it's worth repeating. You spread your risk across many investments with a single purchase. Boom! 2. Professional management or defined strategy. You either get experienced pros managing your money in actively managed funds or a clear passive strategy tracking an index in index funds. Either way, someone or some system is handling the day-to-day investment decisions. 3. Affordability and accessibility. This is huge. You can often start investing in a mutual fund with a relatively small amount of money. Many funds have low minimum initial investments, sometimes 100 or even less for regular contributions. You don't need to be a millionaire. This opens the door to investing for almost everyone. 4. Liquidity. Liquidity is just a fancy way of saying you can generally sell your mutual fund shares on any business day and get your cash back. At the current NAV, of course. This makes it relatively easy to access your money if you need it, although investing is ideally a long-term game. 5. Variety and choice. As we just saw, there's a vast menu of mutual funds. Whether you're aggressive, conservative, saving for retirement, or another goal, there's likely a fund or combination of funds that fits your needs. It's like an all-in-one toolkit for building your financial future. Now, before you get too excited and dive in headfirst, it's absolutely critical to understand that mutual funds, like all investments, come with risks and costs. No sugarcoating here, this is important stuff. 1. Market risk. The value of your mutual fund shares can and will go up and down. This is because the value of the underlying stocks and bonds they hold fluctuates with the market. If the overall stock market has a downturn, the NAV of your stock fund will likely fall too. There are no guarantees of profit. And always remember that famous disclaimer: past performance does not guarantee future results. Just because a fund did well last year doesn't mean it will next year. 2. Not FDIC insured. This is a big one. Unlike your savings account at a bank, mutual fund investments are not insured or guaranteed by the FDIC, Federal Deposit Insurance Corporation, or any other government agency. You can lose money on your investment. 3. Fees and expenses. The silent portfolio nibblers. Running a mutual fund isn't free. There are costs involved, and these are passed on to you, the investor. These fees can significantly impact your long-term returns if you're not careful. A. Expense ratio. This is the big one to watch. It's an annual fee expressed as a percentage of your investment in the fund. For example, an expense ratio of 0.75% means you pay $7.50 per year for every $1,000 invested. Actively managed funds typically have higher expense ratios to pay the managers than passively managed index funds, which can have expense ratios of 0.1% or even much lower. Over decades, even a small difference in expense ratios can mean tens of thousands of dollars more or less in your pocket. Lower is almost always better. B. Sales loads, commissions. Some mutual funds charge a load or sales commission. A. A front-end load is a fee you pay when you buy shares, e.g., 5% of your investment goes to the salesperson. B. A back-end load or deferred sales charge is a fee you might pay if you sell shares within a certain period. C. Many excellent funds are no-load funds, meaning they don't charge these sales commissions. Look for these. D. Other fees. There can be account maintenance fees, transaction fees for buying, selling, etc. The golden rule: always read the fund's prospectus. This legal document details everything: the fund's objectives, strategies, risks, past performance, and, crucially, all its fees and expenses. It might not be a page-turner, but it's essential homework. 4. Manager risk for actively managed funds. If you're in an actively managed fund, there's the risk that the fund manager might make poor investment choices or simply underperform the market. Even the pros don't always get it right. In fact, numerous studies show that the majority of actively managed funds fail to consistently beat their benchmark index, like the S&P 500, over the long run, especially after their higher fees are factored in. This is another reason why low-cost index funds are so popular. Understanding these risks and costs is key to making informed investment decisions. Feeling empowered? Great! So, how do you actually get started with mutual fund investing? It's probably easier than you think. 1. Define your financial goals and risk tolerance. What are you investing for? Retirement in 30 years? A down payment on a house in 5 years? Your kids' college education? Knowing your goals and how much market fluctuation you can stomach, your risk tolerance, will help you choose the right type of mutual funds. Longer time horizon often means you can take on more risk, like with stock funds. 2. Open an investment account. You typically buy mutual funds through a brokerage firm. Many well-known U.S. brokers like Vanguard, Fidelity, Charles Schwab, E-Trade, and others offer a wide selection of mutual funds, including their own and those from other companies. A. You might open a tax-advantaged retirement account, like a traditional IRA, Roth IRA, or a 401k if your employer offers one. These have special tax benefits for retirement savings. B. Or you can open a regular taxable brokerage account for other investment goals. Opening an account online is usually a pretty straightforward process. 3. Research, 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 especially fees. This is where you put on your detective hat. Don't just pick a fund with a catchy name. A. Use the screening tools on your brokerage's website. B. Look at the fund's investment objective. Does it match your goals? C. Check its holdings. What is it actually investing in? D. Review its past performance, but with that grain of salt we talked about. Compare it to its benchmark index. E. Crucially, scrutinize the fees. Look for that expense ratio and aim for low-cost funds, especially for core holdings like broad market index funds. Check for any sales loads. F. Read the prospectus or at least the summary prospectus. Yes, again, it's that vital. Reputable sites like Morningstar.com also provide excellent independent fund analysis. 4. Make your investment. Once you've chosen your funds, you can place an order to buy shares. Many people start with an initial lump sum and then set up automatic monthly investments. This is a great strategy called dollar cost averaging, where you invest a fixed amount regularly, regardless of market ups and downs. It helps smooth out your purchase price over time. Remember, investing in mutual funds is generally a long-term strategy. Think years, even decades, not days or weeks. Don't get spooked by short-term market noise. And just like that, you've unlocked the secrets of mutual funds. From a potentially confusing financial term to a powerful tool you now understand and can confidently consider for your investment journey. Let's do a super fast final recap of what makes mutual funds tick. 1. They pool money from lots of investors. 2. They offer instant diversification to reduce risk. 3. You buy shares and their value is the NAV, calculated daily. 4. There's a huge variety of fund types for different goals. 5. Always watch out for fees. Lower expense ratios are your friend, especially with index funds. 6. They are best suited for long-term investing. Investing doesn't have to be an exclusive club for the ultra-rich or financial wizards. Mutual funds have democratized investing, making it accessible and manageable for millions of Americans working towards their financial dreams, whether that's a comfortable retirement, sending kids to college, or just building a more secure future. I truly hope this deep dive into mutual funds has been enlightening and, dare I say, even a bit enjoyable. If you found this video valuable, please give it a big thumbs up. It really helps spread the knowledge. And make sure you're subscribed with that notification bell dinged so you don't miss our next financial explainer. Thanks so much for tuning in. Remember, knowledge is power, especially when it comes to your money. You've got this. Until next time, invest wisely, stay curious, and keep learning.